Hey everybody, welcome back to 5 Minute Financial Markets. Well, I said yesterday that the market was heading for a big move one way or the other. We had this upward trending channel that was converging with this downward trending resistance line, and something had to give. Today it did, unfortunately, to the downside, with a big 2.5% drop on the S&P, closing off the lows of the day right around 390. I always talk about those $5 increments on the SPY being big levels of support and resistance. True again today. This wasn't completely unexpected. As I mentioned on Tuesday's video, we've got one of the biggest options expirations of the year coming up on Friday. Over 6 million shares of open interest on the SPY alone. Trillions and trillions of dollars of options set to expire on Friday. And max pain on the SPY for Friday is 392. If you're not familiar with the concept of max pain, it's basically what is the price that this product has to settle at the options expiration to make the most amount of money for Wall Street and cause the max pain for everyone else who's buying options. Generally speaking, it's the Wall Street professionals who are writing the options and the everyday folks like you and me who are buying them. So the ideal scenario for Wall Street is for this product to settle at the dollar amount where most of those options expire worthless. They collect all the premiums and there's no payouts for you and me. As of right now, that point is 392, so a sell-off coming back down to that level makes a lot of sense. We'll have to take a look tomorrow morning before the open to see where max pain is heading into the expiration. It figures to move around as people are buying and selling puts and calls, but you want to pay attention to the max pain number as well as where are the big put walls and the big call walls. So right here, we've got a big put wall at 380, a big call wall at 420. That doesn't really help us a lot. That just basically tells us it's got to expire somewhere between 380 and 420. Being that it's at 390 now, that's pretty much a given. But when you scroll down and see what the payouts look like at those different levels, you get a better idea of what range Wall Street wants to see this close in. And right here, it looks like about 385 to a 399 would be ideal. Now, while today was extremely bearish, not everything is looking to the downside. We do have a slightly bullish divergence forming on the smart money versus dumb money indicator. If you haven't seen this before, the smart money is the bond market, HYG. The dumb money is the stock market, the S&P. Why do I say that? Well, think of it this way. How many idiots do you know who trade stocks? Probably a lot. How many idiots do you know who trade bonds? Probably not very many. So when you see divergences between the stock market and the bond market, pay attention to the bond market. They're usually right. Let's take a look at what's happened historically when the stock and bond markets have diverged. Back here in January, you saw a higher high on the S&P. During that same period, you saw a lower high on the HYG, and the market sold off immediately after. Same thing in March, higher high on the S&P, lower high on the HYG, and a sell-off. Same thing in August, higher high on the S&P, lower high on the HYG, crash. So what we're seeing here is a big lower low on the S&P between November 17th and today. But on the high yield bond market, it's a higher low from that same period. That doesn't mean you should go out and get long today, but it does mean that there is some possible relief on the horizon. We'll need to see this confirmed to make sure that HYG doesn't make a lower low in the coming days. Taking a quick look at silver, which has been on a tear lately. We had a big down day in silver, which is definitely expected. We talked about this. It was getting up to the overbought region on the RSI, the momentum indicator. Definitely due for a pullback. And look at where it pulled back to. Right back to the top of the channel that it was trading in before. We could potentially see further weakness and retracement back into this channel, but I also wouldn't be surprised to see it bounce off of here and continue higher on its way to $25 an ounce. But that's all going to depend on what's happening with the US dollar. The dollar showed a lot of strength today for the first time in a long time, up about 1%, but it did not reclaim this high from a couple days ago, nor did it break through this previous level of support. Until it does that, it's still clearly in a downtrend, and we have to expect further weakness from the dollar until proven otherwise. Weakness on the dollar is good for silver, good for equities, and good for almost every other asset that's priced in US dollars. That's all I've got for today. Keep your head up and hang in there, and if you enjoy this content, please hit like and subscribe. See you next time.